Ivy Subramaniam, Managing Director and Chief Investment Officer with Quantum Advisor, joins us. Ivy, good morning and thank you for joining us. The world is bothered about geopolitical tensions, the standoff between Ukraine and Russia. As a money manager, are you worried about geopolitical concerns?
Yes, I would be worried about any global events which can, shake the relatively peaceful atmosphere. So to that extent, it is a worry as to how this whole Ukraine thing could develop. It could either get resolved at a local level and therefore, whatever worries we have may just vanish, or it may even escalate to a much higher problem. So yes, I am cautious, but that doesn't mean that you don't invest in the markets based on valuations, because this will pan out. So at best we could look whether a particular company in India is directly affected by this, or if there is any indirect way they get affected, then we need to see the valuations and how things will pan out, and then accordingly invest. But to give a short answer, yes, I would be worried on any of these events which take place.
Ivy, given what is happening to other emerging markets like Argentina, Turkey, Brazil and now Russia, do you think somewhere India could be a indirect beneficiary?
Yeah, maybe very indirectly, in the sense like some people are relatively more confident about India and the way we have tackled the FX related issues and the current account deficits in the last few months. On a relative basis it does look good, but how much it would actually influence the people who want to invest in India, that's very difficult to call. But we can at least, because we deal and we speak to a lot of large pensions and endowments, we do get a sense that the comfort seems to be on a relatively better mode as far as India is concerned. But again, as I said, it need not translate into immediate flow of money, but I guess it's something which is positive.
Ivy, what is it that you've made of the monthly auto sales figures? It's a mixed bag, but there do appear some green shoots.
Yeah, like again in your earlier shows, I did say that we have had fairly strong growth in 2009, 10, 11, and you do require a cyclical slowdown in many of these products. And I think that's what's been happening. And given the fact that in general the economy has been slowing down, and inflation is high, which means that certain people who are comfortable buying with leverage, maybe they will postpone, and that will have an impact on the automobile sales. All said and done, if you really look at the long-term needs of automobiles, whether it's two-wheelers or cars, structurally we do require many of these vehicles in smaller towns and cities. And I don't see any risk in that. At best, we need to identify companies which are well positioned in terms of what kind of products they sell. But that's something which we need to do research on. But overall, I'm quite okay with the slowdown, and I'm continuing to be very positive on this sector.
Do you think consumer staples, especially consumer FMCG names, have they corrected enough, and do you think they offer a decent entry point once again, names like ITC, HUL, Britannia, Colgate?
I personally think they are still expensive. Personally, in the sense, our in-house research still suggests that they are expensive. And despite the fact that the growth is good for these companies, whether you want to pay such high valuations, at least we are not comfortable. We have seen these companies trade at lower valuations, but it takes a long time for these kind of companies, or it's like once in a decade opportunity to buy at extremely attractive valuations. But I would rather wait and buy at attractive valuations than presume that things would work itself out even if you buy at higher valuations. So right now we don't have any consumer staple stocks in the portfolio. We sold out of HUL sometime around the beginning of last year. And I continue to monitor it, but at this point I still find it expensive.
What about capital goods, Ivy? Do they form part of your core portfolio?
Yeah, they do form in the sense, I don't know what's your definition of core, but in the middle of last year, many of these stocks became extremely attractive, whether you look at Larsen & Toubro or Voltas or, variety of these companies were pretty cheap. Again, looking back, these companies go through cycles. In 2007, I think many of these stocks were quoted probably at a price to book of 5 times or even 6 times, assuming that India's infrastructure growth will continue forever. Around the middle of last year, many of these stocks were available at close to 1 time book, and some of these companies have fairly good balance sheets also. So even if things don't work out in the immediate future, we didn't find any risk in owning them. And we did buy, and some of them have worked out well, but there's still a lot of upside left in many of these stocks. So I'm positive in some of the fundamentally strong companies where the balance sheet is good, and order flow may be slow right now, but going ahead I think it will pick up.
But Ivy, most of the capital goods stocks, at least A quality capital goods stocks, have already appreciated by about 30 to 50% from the recent lows. Crompton has moved from 90 to 130, Voltas has moved from 90 to 130, L&T is up from 850 to current levels of about 950 plus. Do you think a lot of price adjustment already is in the price, and till the time fresh leg of earnings will not kick in, these stocks will not go anywhere?
It's very difficult to say it won't go anywhere, because if the order flows improve dramatically as we have seen in the past, then these companies' earnings can grow at a significantly faster pace. At the stocks which you mentioned at, say, Larsen & Toubro at 850, or even Voltas below 100 or Crompton below 100, look to be extremely cheap. So right now I haven't seen these stocks go up to a level where I would say they have become expensive. So it's in a zone where it's neither cheap nor too expensive, and there is still some steam left in many of these stocks. So yes, they have appreciated, but they appreciated from extreme low levels of valuation, and they have come to a level where still there is upside left in some of these companies. And in certain companies I actually see a lot of upside left. So I would continue to hold them. Maybe it will not happen in the next few months, maybe it will not go up again by 40-50%. But in the next 2 years, I can see a lot of upside in many of these stocks.
How is it that you're approaching banks right now, Avi?
We continue to be positive, but at the same time, extremely cautious as to what kind of managements we are buying into. Many of the banks are saddled with bad assets. So we need to, be careful as to which kind of banks you would like to buy. So we have a mix of both private sector and public sector banks. Again, in the public sector banks, I prefer larger ones like SBI. So there is a problem with the asset quality right now, but valuations are also attractive. And once the economic cycle comes back to normal levels, I think some of the bad loan issues could get sorted out naturally.
Ivy, a quick 30-second take on private banks, because of late you've been a big buyer in private banks. Are you still looking at buying private banks on every decline?
Yeah, if the valuations look attractive, I would be happy to buy into them, and we have been adding into private banks the past few months. Again, we recognize that there are near-term headwinds in terms of asset quality and even interest rates. But on a longer-term basis, given the opportunities for credit growth and for many of the new kind of products which they launch, we think the risk-return trade-off would be in our favor. So therefore, I am happy to buy into many of the private sector banks.